I will say there's another bubble which I also think affected Jamaica, but it was mainly in the US, which was the housing bubble, the housing crisis of 2008, I think, or 2007, 2008, around there.
Mm-hmm.
So, the American dream, part of the American dream that they sell is home ownership.
Mm-hmm.
And at that time, that turned into, a whole speculative fever. So that there is like easy credit, meaning it's easy for you to get like a loan at the time. So interest rates,
Mm-hmm.
I think, were low. It's easy for you to get a loan to build a house or to buy a house,
Mm-hmm.
right? And so that's a mortgage. And so also there are a lot of factors. You remember we were talking about bubbles and how they form, and it's
Mm-hmm.
multifactorial. Like many factors cause bubbles.
Mm-hmm.
So one, yes, it was easy to get a loan at that time. Two, mortgage brokers, those people that
Mm-hmm.
you know they're incentivized. They're actually incentivized to
Mm-hmm.
sell you mortgages at the time. They actually had
Mm-hmm. Or home loans.
short-sighted, yeah, incentives. And so imagine now you get paid based on every mortgage or any loan that you lend out, right? That can be pretty negative because if you're incentivized by just sheer quantity of loans and not the
Mm-hmm.
quality of loans,
Mm-hmm.
that is literally setting the stage up for,
Mm-hmm.
yeah.
Mm-hmm. You'd have skin in the
So
game, so
precisely.
it's.
Um,
Mm-hmm.
and so you wouldn't necessarily care if borrowers could pay back long term. You're just
Mm-hmm.
trying to make money selling these
Mm-hmm.
houses or selling
Mm-hmm.
these loans to people that want houses.
Mm-hmm.
So, um, you know, home buyers at the time only believe housing only goes up. So prices started surging from the 2000s, going straight up. Got
Mm-hmm.
even worse early, I think mid. So it was like 2004 to 2006. It started to like skyrocket, right? And at that time, I think within a decade, the housing prices doubled in under a decade, actually. And so there are certain they did like there's certain indices and they did
Mm-hmm.
like a lot of data and research on the price of
Mm-hmm.
houses and so on, and it reflected this whole national boom. So all in America, people are
Mm-hmm.
buying houses, people are flipping houses, meaning buying and selling in like a short space of time.
Mm-hmm.
And how because housing prices are just going up. Imagine you buy a house
Mm-hmm.
for 100K US and
Mm-hmm.
sell it for 140K
Mm-hmm.
US same year in like 6 months.
Mm-hmm.
That's 40 grand
Mm-hmm.
US profit
Mm-hmm.
in 6 months. And some people
It's
are
a
doing this a
40%
lot.
return, yeah.
That's a 40%
Mm-hmm.
return in 6 months,
Mm-hmm.
right?
Yeah.
Not many things give you that at all.
Mm-hmm.
So, you had flippers buying
Mm-hmm.
condos pre-construction just to resell it in months. And I don't know if you've watched
The Big
The Big
Short,
Short.
yeah,
Yeah,
or Margin
great.
Call, yeah. They talk about those kind of
Mhm.
stuff.
Yeah,
Yeah.
man. They talk
Mm-hmm.
about subprime loans. That's what they call it. Subprime
Mm-hmm.
loans just mean, you know, you're
They're like
give
lower
it your
quality. There was a
it's
higher
a
risk that the
lower
person
quality.
wouldn't pay back.
Exactly. It's a high risk the
Yeah.
person wouldn't pay you back long term. So
Mm-hmm.
that's subprime loans. And so that level started to skyrocket at the time.
Mm-hmm. Mm-hmm.
And so millions took out these subprime loans and
Mm-hmm.
adjustable rate mortgages, all those kind of stuff.
Mm-hmm.
Those complex financial tool or solutions,
Mm-hmm.
which really and truly are just all different types of loans, but they were risky. And they're
Mm-hmm.
risky for the banks because, if people if you're lending out this much money and people are not they can't pay you back. At the time, the
Mm-hmm.
housing, the bubble popped in I think
Mm-hmm.
07 or 08.
Mm-hmm.
And I've been doing a lot of research into interest rates and inflation and the correlation between interest rates and inflation. It's like a seesaw. Now, how that happened was interest rates started to tick up. And interest rates are, you know, let's say Preston wants to buy a house.
Mm-hmm.
The bank is going to lend him at a certain percent So let's say it's 10%. So he wants to buy a house that costs, I don't know, 50 million Jamaican.
Mm-hmm.
So the mortgage he would end up having to pay back. Let's say it's just he's borrowing 50 million. He has to
Mm-hmm.
end up, and the interest rate is 10%. He has to pay back 55 million. So the 5 million is that interest.
Mm-hmm.
And so interest rates ticked up. So imagine now it gets more and more expensive for you to take out a mortgage because
Mm-hmm.
interest rates are going high. Um, and then home supply started to grow too because there are more
Mm-hmm.
houses being built.
Mm-hmm.
So that's demand dropping because interest rates are going up
Mm-hmm.
because it's harder to get a loan, or it's more expensive to get a loan.
Mm-hmm.
Supply increase, right? Prices stalled and just fell. That's just
Mm-hmm.
how the market kind of works. And once
Mm-hmm.
prices stopped rising, the
Mm-hmm.
flippers vanished, default spiked, right?
Mm-hmm.
So people just say, "Yo, can't pay you back, bro." And imagine
Mm-hmm.
going to NCB, and NCB is just like, "Yo, where's the mortgage?" And you're like, "Well, man, I have it this month. Check me back next month." you know.
Mm-hmm.
But imagine that now on a huge scale. That's millions of people, and that triggered the global
Mm-hmm.
financial crisis.
Mm-hmm.
So yeah, that was just a short synopsis on the financial crisis at the time.
Mm-hmm.
It had a real impact on Jamaica, for
Yeah.
sure. You know the saying, when the US sneeze, Jamaica catch a cold.
Mm-hmm.
Yeah, the same thing happened even with the housing crash. You know, because you can think of it in many different ways. I can't even imagine remittances. Imagine now all these people used to send back money to Jamaica,
Mm-hmm.
and that was a huge source of income for a lot of Jamaican families. But
Mm-hmm.
when you check the data in '09, remittances fell by 11%. That's a drop of
Mm-hmm.
like 225 million US dollars.
Mm-hmm.
Because
Oh.
people in the US and the UK, they struggled.
Mm-hmm.
And then imagine tourism slowing down too,
Mm-hmm.
because not many
They have
people
less
are
money to spend.
less less disposable
Could they?
income.
Yeah.
hmm And
Mm-hmm.
foreign direct investment too. So these are companies in the US countries, or
Mm-hmm.
first world countries that would invest here.
Mm-hmm. Mm-hmm.
All of that money would have dried up because
Mm-hmm.
investors are now a bit more cautious because, oh,
Mm-hmm.
if this can
Could have.
happen here,
Mm-hmm. Or it's just like,
you know.
even like, say you're gonna set up a hotel because a
hmm
lot of people are coming into the country, but then a lot of people, like, less people start coming into the country. You'll be like, maybe I shouldn't set up the hotel. Maybe I should actually set it up this other place.
hmm
So it's just there, that the issue of capital. But I think it's
hmm
one of the things that you touched on, that I think it was Morgan, how was it, Housel or Housel? I don't want to.
Housel.
Housel, okay. I remember he spoke about the whole thing with the bubble is that you have a lot more investors who, as you said, they aren't thinking 10 years down the line, 5 years down the line.
hmm
They are, it's like they maybe don't really understand the risk of investing in the business at this price. And based on, it's gone up 1,000% in the last, 5 years. And maybe the actual profit or, earnings of the business, it may not actually pan out. So it's like, if you're
hmm
buying it, once again, it's like if you thought, say you're buying a car that now you think, so now it's like $1 million, but you say, hey, I think in a few years it's actually going to even be worth more. But I guess a car is probably a bad example. The cars don't usually,
Appreciate like that.
yeah. So I don't know if maybe a car is an example, but you're buying the business because you're like, hey, when they add the .com, I expect that they're gonna earn a lot more money, and then that's gonna allow them to pay more dividends and maybe buy back more shares and expand more and that stuff. And so you're willing to buy it at whatever price you're seeing it trading at. But then, what if all of that doesn't happen? What if the profit goes down and they continue to do poorly, and it's already gone up 1,000%? There are a lot of people who are in it, and maybe they just sell because they're like, hey, I can't bother, and
hmm
you could just have a rapid drop in the price. So it's like, oh yeah, one of the things you were stressing was that you have a lot more people with that shorter term mindset you're saying. So he didn't specify a time period, but maybe they're just thinking a week, a month, a day.
Yeah.
And they're just like, okay, I don't care if it's 20. It's $20 now. I think I can sell for 22 tomorrow. That's good for me.
Mm-hmm.
And then it could just go higher and higher and higher and higher. And there's almost like this positive
It's a
feedback loop.
momentum thing.
Yeah, there's like a positive feedback loop where some people buy it, it goes up. If a lot of people start buying it, more than people who are selling it, the price will go up. So people hear about the price going up, and then people report, oh, it was the best performing company. It's going to
Yeah.
revolutionize the world. You see stuff online that then encourages other people to buy it. And they may not have like, finance background, and they say, oh, I shouldn't buy above a price to earnings of this or those kind of things. They just say, hey, the stock is there. I want to buy it. I just buy it. I just buy it. And then that
Really?
causes the price to go up more. And then more people buy it. And it's like cascades, and it just goes and goes and goes and goes until
I
one
think a
day
good
something changes. And then bam,
yeah
pops. The bubble pops.
bubble pops. And I think a good excerpt from the book is he says momentum attracts short-term investors, short-term traders in a reasonable way. So bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. And you're right about that positive feedback, because that process feeds in on itself. So as traders push up the short-term returns, they attract more traders, and before long, and it doesn't take long. The dominant market price setters, with most authority are those with shorter time horizons. So bubbles aren't really about valuations rising or so on. That's just a symptom of something else. That's it's time horizon shrinking more as more short-term traders enter the playing field. So yeah, fam. I think also, I looked at the JSE's report back in 2008 when the housing crash
The JSE is
happened.
in Jamaica Stock Exchange.
Yeah, I looked at some of the main market data, and the index actually fell by 25% in 2008, around 25%.
You're saying the overall
That's
market dropped, like the
the
price of all of the
overall
different
market.
businesses. Yeah.
So if you average the price of all the companies on the stock exchange in 2008, it actually fell by 25%. And that's a crazy drop for the market. So yeah, I mean, and I think we entered into a recession the year after that, and it was tough. So it definitely affected us in Jamaica.